Okay, ladies and gentlemen, so for today's screencast, we're going to focus on a type of investment called stocks. So we're going to be taking a look at the stock market, what stocks are, and we're going to be taking a look at everything from what might make a company want to sell their shares of their company through the stock exchange, to what causes the price of a stock to go up and down, to what factors might you consider before you purchase a stock. So the first thing, we're just going to kind of get some basics out there. So what exactly is a stock? So I'm sure a lot of you guys have heard of stocks before, but to give you guys kind of a standard definition of it, stocks are a type of security that gives stockholders a share of ownership in a company. So what does that mean, really? Essentially what that means is you can buy shares in a particular company. It doesn't really mean you have a lot of influence over what the company does, but you do kind of gain wealth when the stocks of that company go up. So essentially, you're kind of like, the best way to put it is you're becoming an investor in a particular company by buying shares within that company. So that company is offering their shares in that company to be bought publicly. So we have to kind of get into like, why would they do that first, and like what benefits them. So first of all, this means that what this is referred to as, or what this is referred to is a company going public. And what that means is that you might have a private company. It doesn't mean that you can invest in that company publicly through the stock market. So when a company makes themselves and shares in their company public, where it's open to the general public to purchase and buy shares in their company, that's considered going public. So why would a company do this? Why would they allow shares of their particular company to be bought by the general public? So there's a lot of different reasons. The first major reason is probably to potentially generate capital for their company. So if maybe they're trying to expand into different areas, if they're trying to open up new factories or develop a new technology, they might need money. And so this is a way to kind of generate capital for the company by getting you to invest money in their company through purchasing a stock. It can help them kind of build some kind of public image. So when you go public on the stock exchange, more people might know who you are and what your company does. So it can kind of like build up your image a little bit. It also can definitely help your company to grow, like we just talked about. So you're generating more capital, which means you're going to have more available funds to grow your business and expand your business after you go public, potentially. So those are some of the reasons that a company might offer shares in their company to be bought. Now, why would you want to buy shares in any particular company or make stocks a part of your investment portfolio? So we talked about savings accounts, we talked about credit a little bit, we talked about investing for your future as far as your retirement. So why would you want to invest in stocks? What are the reasons for this? So let's kind of go through some of the big reasons you might want to buy shares in certain companies. First thing is that it's going to help your money to grow. So remember, we talked about this whole idea of staying ahead of inflation. If you pick your stocks correctly, you can really help your money to grow, in a profound way through the stock market. So it's really going to help your money to grow over time and build up your wealth. So that's kind of the second big point. This kind of expands your wealth. As you invest in stocks, you can kind of you're basically investing in your future and potentially could expand your wealth. And like I said, it can help you to beat the rate of inflation. So remember, as we said, if you just take your money and you don't invest in it anything, essentially it's losing value over time. So stocks is a good way to potentially not only keep up with the rate of inflation, but go beyond the rate of inflation. Now, as like this intro graphic here kind of implies, the stock market is kind of a risk, though. So you can definitely invest in the stock market, and help your money to grow and help your wealth to grow. But it could also, you could lose your investment easier in this type of investment. So some of the other things we talked about, like CDs, and 401ks and other types of investments for your future, they're a little bit more sound. It's more likely and riskier that you could lose money on the stock market than you could in some of these other investments. But the upside to it is you could also make a lot more money on the stock market. So it's really a skill. There's a lot of research that has to go into the types of stocks you might be interested in purchasing before you kind of sit down and you make a lot of these decisions. So the thing we have to kind of talk about a little bit is what causes the price of a stock to go up and down. So the first thing you want to know is that all stocks that have a selling price, and the selling price is per share. Okay, and that can range from something we have that's called penny stocks that you could buy, very cheaply for pennies, to stocks that sell for hundreds and hundreds of dollars, or $500, $600, $700 a share. And so they can get very expensive, and everything in between. So what we have to kind of figure out is what causes or what sets that price, okay? And it's very similar to pretty much everything else in our economy. So remember, we live in primarily a demand economy, the idea of capitalism. So when they call like where stocks are sold the stock market, think of it in very similar fashion to any other market that you might go into, whether it's a food market or a clothing market. What determines the prices in those particular areas in a demand economy? The real simple answer here is supply and demand. So you have a certain amount of shares that are available to the public, and the company decides how many shares are available to the public. That's the supply. The demand is how badly do people want to buy these particular stocks, and that potentially can drive the price of the stock up or drive the price of the stock down. So essentially it's governed by supply and demand, just like all other commodities within our country is driven by supply and demand. Same thing goes for, let's say, oil. If the demand for oil goes down, the price of oil is going to come down. Same thing with any kind of product. And so that's kind of what determines the price of the stock, is supply and demand for shares in that stock. Now, what can cause people to want the stock more? Maybe they see that as potentially being a good investment, so more people want to invest in it, and therefore kind of increases the price of that stock. And so when you look at kind of the overall market, this is not for a particular stock, but they'll sometimes refer to a market as a bull market. And when they say it's a bull market, that means overall, like, stocks in general are kind of on the rise, and it's a good indicator for a positive outlook for the economy. A bear market is where overall stocks are kind of on the decline. And so these are just two terms that they use. A bull market for like overall stock prices in general on the stock market are going up, and then a bear market is kind of like overall the stock prices are kind of on the decline. Now, for you, if you're thinking about investing in a stock or a particular company, what are you thinking about? What are factors you're considering before you buy that stock? So first thing, of course, is the price of the stock. So like I said, they can range anywhere from penny stocks all the way up to hundreds upon hundreds of dollars per share. So you have to think about a couple of different things. So if the price of the stock is high, that means that it's in high demand, which means probably that company is doing pretty well, which is causing the price of that stock to go up. But it also makes it very expensive to invest in that company. You might not have $500, $600 to buy shares in a particular company. So you have to kind of pay attention to the price of the stock. And again, it's an investment, but it's an educated investment. So you want to try the best you can to buy stocks, when you still think they have room for growth. So that can be buying them when they're on the decline and thinking that they're going to go back up. It could be buying them while they're still going up, but thinking like, hey, this company is a great company. There's way more room for growth within this company, so I'm going to buy stocks now. And so it really is kind of an educated skill to watch the stock market and watch companies and start to think about potentially what you might want to invest in. So if it's something that you're interested in, you really have to, I would advise, start to look at the stock market for a little bit of time before you actually start to purchase stocks. So you get a kind of a feel for like what companies are doing and like areas that you might be interested in investing in. Okay, so like a lot of this is depending upon what you think is going to happen with that company. Do you think the company's going to expand? Are they going to be moving into different ventures that potentially is going to grow the company? And if you think that's going to happen, potentially it might be a good stock to invest in because you think the price of that stock is going to go up because demand of it's going to go up. So like think about some companies that are really profitable now, that if you invested in them years ago, you'd be doing really well right now. So let's say, for example, like Netflix. Netflix, if you had invested in that company in the beginning, before online streaming became popular, when they were just kind of like sending discs to people through the mail, you'd be doing really well right now. Or let's say, for example, Amazon. If you invested in Amazon when all they really did was sell books, Now they pretty much sell everything, right? So if you can kind of predict and think about what companies might expand and do well, and you can think about the future of that company, and potentially you can find some pretty amazing investments. So another thing that might factor into whether you want to buy stocks is the current and future economic conditions of that particular industry. So if like it's a technology industry, maybe you think that that's going to be growing over time. Maybe certain industries you think are going to be shrinking. So maybe, let's say for example, you might not want to invest in like brick and mortar retail stores because you think over the next 20-25 years, a lot of brick and mortar retail stores are going to go out of business, and as an industry it's going to decline, so you just don't think it's a good area to invest in. The other thing you might want to think about is the overall economy as a whole. So right now we're experiencing a massive economic catastrophe resulting from the coronavirus. Right? So you have to think, is this a good time to invest in stocks? In certain ways it might be a good time to invest in stocks because a lot of companies, the price of their stocks are declining. But then again, you have to think about it's also an educated risk and educated investment that you're making because you have to think, well, we have to kind of predict what companies you think are going to rebound from this and what companies you think not. Because certain companies out there are going to fold as a result of this catastrophe that we're going through. And if you invest your money in those companies, you're not going to get that money back. But certain companies might just kind of like temporarily go down. You could buy that stock pretty cheap, and then it's going to go back up and you potentially can make a lot of money. So these are things that you have to kind of think about when you're thinking about potentially purchasing shares in a company. So we kind of just touched on it there, but you want to think about, I'm not going to go through these, but you want to think about what stocks do you think would make for good investments now. So we'll talk about a couple of companies that, let's say if you kind of could see into the future, or if you were watching what was happening in China and what was going on in other parts of the world before it came to the United States, you might have invested in certain companies on the notion that you thought the coronavirus was going to have a huge impact on America and America's economy. So you might have invested in, let's say, for example, Zoom, the platform that we've been using for our classes, or Amazon because people are reluctant to go outside to purchase goods, so they're purchasing more through online, or Netflix or Hulu, or some of these companies that potentially could expand tremendously as a result of this. So think about now. You have to think, when you invest in stocks, you're investing in what you think is going to happen in the future a little bit. So think about now, what companies do you think potentially are going to benefit now down the line? So they've been talking about all these different pharmaceutical companies, people trying to work on vaccines. Think about like, well, who produces these things? Because that's going to be a billion-dollar industry coming up, people producing these vaccines and producing things for the coronavirus. So you have to kind of think about what you think might potentially make money, a month, 2 months, 3 months down the line when you're thinking about investing in different companies and stocks. Now, there's different styles of trading, so we're just going to kind of touch on this. Some people engage in day trading, which is they try to buy a stock during the day and then sell it that same day, basically. And that's kind of like a very short-term way of trading. And you can make money doing that, but you have to really be in tune to what's happening in the market because the price of a stock fluctuates during the day. Minute by minute, it could fluctuate and go up and down. And so like you really have to be on top of that to be a day trader, and it has to be something that you're really invested into. Other ways you could use the stock market is a short-term investment. So maybe you're looking for like a couple months investment. You think a company's going to kind of rise and you want to get out before the stock price goes down. So more of a short-term investment. You could also use it for long-term investments. So you could use it for like 5-10 year investment. You can invest in the indexes, which is kind of investing in the stock market's health as a whole, the economy's health as a whole. And these are more long-term ways of using the stock market. So there's lots of different methods that you can use to utilize investments in the stock market. Okay, so we're going to stop our lesson there. In our next lesson, we'll probably go into a little bit more of like different types of stocks that you can invest in to get a little bit more advice about these short-term and long-term investments.